An investment is an asset purchased with the expectation that it will generate income or appreciate over time. In finance, common investments include stocks, bonds, real estate, mutual funds, and to a lesser extent, commodities, annuities, and options. Many investments trade daily on the public market. Current events and company performance can cause a company's stock to rise or fall, and significant news can affect the entire stock market. Generally speaking, if a person follows safe investment practices, the longer they invest for, the greater the chance they will grow their wealth. Inversely, the shorter the period of investment, the higher the risk of that investment losing money. But with all investments, there is always some risk that the value of the asset will decline rather than increase. Despite the risk, wise investments are one of the best ways to grow your money. Let's say two brothers each inherit $100,000. Hubert does not invest his money, choosing instead to hold it in a checking account that earns no interest. Ivan, on the other hand, invests his money in some broadly diversified mutual funds. Every day, Ivan's investments change in value. Over 10 years, Ivan's average investment growth was about 7.2% per year, meaning his total investment grows to about $200,000. His brother Hubert, however, would still only have $100,000 in his savings account.
So this short video, which was downloaded from Investopedia, defines investment. Now we're going to go to some of the key learning points from that definition. Just a moment, I'm trying to move my slide forward, but apparently the option is not available. Just give me a moment. Okay, great. Now, some of the key learning points from that definition is: number one, an investment is the acquisition of an asset that appreciates in value over time. So we have value and we have time. Those are key elements of that definition. Now, if you talk about time, you understand that the longer the period of your investment, the greater the overall value of your assets. And the shorter the amount of time you invest, the higher the risk of your investment actually tanking and losing value. So this definition debunks that myth that some people have, where they believe that they will invest and be getting monthly returns on their investment, and they can double their money in 1 month, get 100% in 3 months, etc. All those are schemes that they look attractive and they want you to part with your capital. So some of them are not genuine investments. Investment actually appreciates assets, true, but it takes time. When somebody is promising you appreciation and telling you it will not take time, they might be looking for a way to scam you of your capital. Pay attention to that. Now, every investment has risk. There is no investment under God's green earth that does not come with risk. Whether you are doing real estate investing in any form, whether it is land banking, whether you are giving your properties out for rent, these investments carry risk. Even you build a house now and you lease the house, you can get a tenant that is very troublesome, that does not pay their rent, that destroys your property. So there is no investment without risk. As a matter of fact, risk goes alongside with investment. So what you always need to do is to take calculated risk, to manage your risk, and to invest according to your own risk appetite, because people differ in their risk appetite. If somebody is an old person, they might be looking for things that are more stable, things that will just be, for example, they can be building their their pension portfolio, and by the time they are receiving their pension, you see that they are very interested in things like fixed deposit, for example, just gradual returns on their investments. They are not looking for anything massive. However, somebody that is young, still yet to start family life, might be open to taking riskier investments, buying assets like cryptocurrency, etc. So risk differs according to things like factors like age, factors like the amount of capital available to the investor. But despite all this risk, it's important for you to understand that investment is one of the best ways you can grow your money. Now, one of the ways you can checkmate the risk is to diversify your investment portfolio. And I'll give you an example. In the time period of COVID 2020, the shares of airlines were nosediving, they were going down. But the shares of things like telecommunication, like this very Zoom we are using for this call, they were going up. So if you have a diversified investment portfolio and you have assets in different categories across different industry, you will see that your portfolio, when maybe one industry is going down, another one is going up, so your portfolio will be able to balance itself, and you can always liquidate assets that are in a profitable position, and the assets that are not in a profitable position, you can leave them until the market favors them and they begin to go up. So diversification is one of the ways to reduce your overall risk. It can also impact your future ROI, but it is very important to take steps to protect your investment and to reduce your risk. If you are following, type following in the chat. Now we're going to talk about a particular kind of investing, which is the acquisition of shares, units of ownership in companies or financial assets. Now, if you buy shares, you are usually referred to as a shareholder or a co-owner of that company. You are aware now that companies like Dangote Refinery very soon might be doing their IPO, and in this moment they are in the period of private placement. So people are buying their shares. The private people who have accredited investors who have access to that project are already acquiring their shares. Later on, when they list publicly, those early investors will be able to sell their shares, and then people who are in the public domain, those for example, the people who can access it through the stock exchange market, they can also buy the shares through their broker. Now, shares, what are they? How can they help you increase your wealth and even get a stable income in the form of dividends? That's what we'll be talking about right now. And then we will connect that to the subject matter of tonight's conversation, which is from tech tenants to AI co-owners. So this night will be telling you how you can become a co-owner in an AI company and the step-by-step ways you can do that through the DigiU platform, what I refer to as the DigiU transformation, transforming you from a tech tenant to a co-owner in the AI ecosystem. All right, so shares, I already said, are unit of ownership in a company or a financial asset, right? For some companies, shares also exist as a way to provide distribution of profits in the form of dividends. And so shareholders of a stock that pays dividends at the end of the accounting period, which can be a quarter, which can be biannually, or which can be annually, the profits are declared. Profits are also, the allocation of profit for dividends are also made known and distributed. So you just sit down in your house because you own shares. Once the company gets to the point of declaring dividends, you just receive your own alert, and that's it. All you need to do is to own shares in the company, and if they pay dividends, you will get your own. I mean, is that not amazing? So this is one of the ways that people build wealth, and they don't have to rush to do 9 to 5 and then break their back throughout the year. In fact, this is one of the ways that if you are worried about, oh, what will I be doing when I finally quit my 9 to 5 or when I finally retire, this is one of the ways you can start preparing for that reality, because it's a reality all of us will have to confront. So you can start building your portfolio of dividend paying stocks so that when you are now retired, you can just be sitting at home receiving not only your pension, be receiving your dividends from the companies that you own as well. So as you are buying the next iPhone, buying the next what's it called now, the next iPod, buying the next, you also be thinking, can I buy shares in this company? Can I own shares in this company? Should I or should I not own their shares? What are the factors I should consider? And these are some of the things we'll be discussing here tonight. Now, it's important to mention that it's not all shares that pay dividends. It's not all shares that pay dividends. There are shareholders who own stocks that pay no dividends. And the only way they can profit is through what they refer to as price appreciation. I bought at 10 naira, I sold at 20 naira. It appreciated 100%. So that is how you get your own returns on investment. So those companies that don't pay dividends, they usually reinvest the total profit in the development of the company in order for the price of the share to appreciate. Am I speaking too fast? Please type fast if I'm talking too fast, slow if I'm talking too slow, normal if you are comfortable with my pace, so that I will know whether or not to, how to adjust moving forward. If I'm talking too fast, let me know. Okay, Mr. David says it's normal. Okay, let me wait for 2 more feedback to know how to pace the presentation. Ms. Patricia says it's normal. Okay, so that's 2. 1 more person. Fast, slow, normal, how is it for you? Great, thank you, Mr. Godwin. So everybody has said normal, which means I will maintain the same pace. All right, now, types of shares. I already categorized dividend shares and non-dividend shares. So we have shares that pay dividends. When the company makes profit, shareholders participate in the profit sharing in the form of dividends. And then there are non-dividend shares. You, as the holder of such a share, you are not getting any dividends, but as the share price increases, you have the opportunity to sell and get profit. Now, there are also types of shares categorized according to the time in the company's development or the stage in the company's development in which you buy those shares, in which they are bought and sold. And if we categorize according to this, we have 3 kinds of shares. Shares of private company, shares of company that are just getting into the stock exchange market, which we can also call, let me start again. Shares of private company, which we can also call pre-IPO shares, because this is before the companies do their initial public offering. IPO is initial public offering. So if we say pre-IPO, we are saying before public offering. So this is for private companies. So shares of private companies are pre-IPO shares. We will talk more in details about them later. We have shares of companies that are just entering the stock exchange market, like Dangote is about to enter. So that IPO stage, initial public offering stage, we call those shares IPO shares. And then we have mature companies that have been in the stock market doing business for a while. We can refer to them as post-IPO shares. Now, we are going to look at pre-IPO, IPO, and post-IPO shares and do some more deep dive. Now, pre-IPO shares, the important thing to note about them, one moment. I cannot find some slides I need on my screen, and let me check why they are not there. Just a moment. Let's see. Okay, I see. Right. Pardon the delay. It is just temporary. We should be streaming again very soon. Awesome. So we're back. Like I was saying earlier, now we are going to dive deep into the difference between pre-IPO shares, IPO shares, and post-IPO shares. Please note that this I'm doing for some of you, I'm laying a very strong foundation, because the foundation is very important. You don't build without foundation. So Ms. Amina said I'm a bit fast. Okay, I'm going to reduce my pace. If you don't build without a foundation, you risk collapsing the entire structure. You need a strong foundation. So if I'm going to, there's a concept in education referred to as scaffolding, and you must teach somebody how to understand the basics before you now begin to go into advanced concepts. So you scaffold on top of what they already know. You cannot teach a child how to read A for apple without teaching them A to Z. Neither can you teach them how to spell without teaching them alphabets and phonic sound. So you need them to have foundational knowledge that you come and build upon. And so based on that, we are building this foundation, which is very important. Now, differences between pre-IPO, IPO, and post-IPO shares. Number 1, in terms of the characteristic, let us talk about ownership. Ownership. Who owns pre-IPO shares? Usually, pre-IPO shares are owned by the founders of the company, or the founder of the company owns shares in his company. Whether the company has gone public or not, the founders, they already have access to ownership of shares in that company. And then in pre-IPO shares, who also has ownership of such shares? We have early investors. Early investors such as people who have the status of high net worth individuals. Because when you talk about investing in pre-IPO shares, it is not available to the public, and so individuals who can have access to enter as early investors are usually accredited investors, people who understand the risk of investing in pre-IPO shares, the risks such as the liquidity and the possibility that the company may not go public. So those people, accredited investors, are usually the ones who know about these opportunities, and they include high net worth individuals, venture capitalists, and mutual funds, etc., angel investors, and what have you. Now, pay attention. When companies like how Dangote right now is giving out their shares, their pre-IPO shares, or doing private placements, they don't go to the public to announce it. In fact, there are entry requirements. I wish you are writing something. I wish you are taking down notes. There are entry requirements. For example, I heard, I don't know how true, but I heard that if you want to take a private placement in Dangote refineries, it starts from around 1 million units at the price of 35 cents per unit. So if you want to enter that, you need a minimum of $350,000 to participate. So I saw that news, and this is one of the things that makes it only possible for high net worth individuals, venture capitalists, and mutual funds to participate at this stage. You understand? So these companies at this stage have entry requirements. Now, another category of people that own pre-IPO shares are employees of the company. How many of you remember that story about Alibaba giving shares of his company to his employees? Because usually when you're starting a company, you need people who believe in your vision. Even Elon Musk also gave shares of his company, SpaceX. Because when you want to hire people to remain and retain them in your company, you need to motivate them, show them, give them a reason to, retain their expertise in your company. You are a startup hoping to attract the best talents. So these people know that their skills can be, well remunerated in other companies. But what should make them choose your company and remain in your company? Sometimes founders give their company shares to their early employees. Are you with me now? So that's how SpaceX gave shares, and Alibaba also gave shares. And some of those companies that went to become big names, all those employees who own those shares turned out to become millionaires. Go and read the news. SpaceX just recently did their IPO, and some of those employees they gave shares to are now in millions. In fact, if you check the interview that some of them granted, they were saying things like what they are now concerned about is their health. So money is no longer their problem. They are now concerned about how to live long in order to enjoy the money that the shares that they were given has just become the value those shares have just become in the market. So now all of a sudden, they used to have maybe, let's just say 10,000 units of shares or 20,000 units of shares. The company went public at $135, and the first week of trading, they already reached $190. So somebody who owns maybe 20,000 units already is seeing that his asset has appreciated. Now, what is concerned is how to enjoy that money, how to take care of his health, because he's no longer seeing the need for the 9 to 5 or the need to make money as a big motivation anymore, because he has already just, his net worth has significantly increased. Elon Musk himself, that very day, his net worth increased by $1.1 trillion, and he became the first trillionaire in the history of the the Forbes list of people who have become the richest men in the world. He's not only the richest man, he's the first trillionaire. Are you with me? Good. Now, IPO shares, on the other hand, they are owned by investors who buy the shares during the IPO. Are you with me? So if you buy shares of a company as soon as it goes public during the IPO, you become the owner of the IPO shares. Then post-IPO shares are shares that are already listed in the secondary market and have been trading there for a while. So you can access those through a stockbroker in the stock exchange market. Good. Now, second characteristic we'll be looking at is liquidity. And when it concerns liquidity, pre-IPO shares, first of all, let me define what liquidity is. Liquidity refers to how quickly can an asset be exchanged for money. How quickly can you liquidate an asset? For example, you own property and you want to sell it. It's not going to be as easy to sell as when you have maybe a different kind of asset. If you have shares in the stock market and you want to sell them, listed shares, all you need to do is go to your stockbroker, go and click sell. If you have cryptocurrency already trading in the crypto exchange and you want to sell, all you need to do is go to the exchange and click sell. Immediately it is sold, you get the money equivalent of that asset and you can withdraw it. So it is very liquid, highly tradable. Now, when you talk about liquidity, for example, properties are not so liquid, like they are not easily assets you can easily liquidate. If you want to sell a property today, you need to engage the services of maybe a property agent to help you attract potential buyers. And they would not just do it immediately. They would need some time to do some kind of advertisement, and then people now know about your property. And then when interested buyers come along and the conditions are favorable, the sale happens. That is when you will now get the money value of your property. And it can take months, it can even take years before this transaction occurs. Because as I speak to you, we don't have a very, should I say, a platform where transactions for such real estate property have been made very easy. And this is an opportunity. For example, for those who are in the real estate, think about what you can do to make this space more easy for properties to be listed, verified, sold, and the exchange of the property is done seamlessly and smoothly. The certificates of the property are transferred from the owner to the buyer. You know, if you can create such a platform, just imagine. So that is also a way to make a solution available to make real estate more liquid and also get profit in the process. But at the moment, the process of liquidating real estate is a bit cumbersome and it takes time. Now, let us talk about liquidity of shares. Shares that are in the pre-IPO stage, they are not publicly traded, so they have limited liquidity. They cannot easily be bought, they cannot easily be sold. So in this stage, if you are able to acquire such shares, you may need to wait until they go public before you'll be able to sell them. Take note. Also, when you talk about liquidity, for IPO shares, there is high liquidity because they are now publicly traded and you can easily buy them and sell them. For post-IPO shares, of course, also it has high liquidity because the shares are already available on the secondary market, easy to be bought, easy to be sold. The next factor we consider is the factor of price. And when you talk about price, pre-IPO shares are sold at a discount. They are sold less than the price in the market. They are sold with what is referred to as investment risk premium. That is the discount that people are giving in order to be able to participate in that risk, because pre-IPO shares are generally considered a very risky asset. If you are buying pre-IPO shares, the company that you are buying it with may not even go public. So in order to compensate you for that risk, they give you the shares at a low price compared to market value. That's what is called investment risk premium. That's the discount you enjoy if you are investing in that pre-IPO stage. For example, the Dangote refinery shares that they are offering under private placement is at 35 cents per share. Although you must buy up to 1 million shares before you are able to, like, they don't just sell one unit, they sell 1 million. So if you are buying The minimum entry is $350,000. So you cannot go in there if you don't have that kind of money. And even if you have that kind of money, you should also understand all the risks, such as liquidity restriction, the possibility it may not go public. So if you are investing in a private company, there are risks that you should be aware of. Now, I hope this webinar is opening your eyes to some of these risks. Beautiful. So the next thing we need to know now is that IPO shares, when you talk about price, IPO shares are sold at market value based on the demand during the, and for SpaceX, as an example, they went public at how much? $135 per share, if I'm not mistaken. And after they went public at $135 per share, which was the value that the company placed to list those shares on the stock market, the shares on the first week of trading rose to $190 per share, which means the market value that was quoted was not even sufficient, because the demand of the shares was so much so that the price went to $190 on the first week of trading. Now, for post-IPO shares, when you talk about price, post-IPO share price is determined by market value, by demand and supply. And that's why it's always going up and coming down, because depending on the demand and the supply, depending on how the asset is performing, investors can buy it or they can sell it. And so the price can go up or down based on the demand and the supply. You see something like BTC, Bitcoin. The price of BTC is determined by demand. So if there's a high demand for it and there's less supply, if more people are holding and they don't want to sell, and then a lot of people want to buy, the price will go up. But then if the supply is very high and the demand is very low, the price will come down. So that is exactly how market value determines the price of the asset. Now, another key point to note to differentiate pre-IPO, post-IPO and IPO shares is regulation. When you talk about regulation, pre-IPO shares have minimal regulation because they are not publicly traded. So the agencies that are regulators for assets that are publicly listed do not necessarily bother pre-IPO private companies as much as public companies. Now, is it that there are no regulations? Of course, there are regulations, but it is not at the level of public companies. It is minimal when you compare to public companies. For example, disclosing your profits, that's a condition public companies must fulfill. Private companies, not so much. So there are minimal regulations here compared to public companies. Are we together? Beautiful. So IPO shares, on the other hand, they have extensive regulatory requirements in order to ensure transparency and the protection of investors. So when you talk about regulation, IPO shares are heavily regulated. In fact, before you even go public, you have to meet the conditions of Securities and Exchange Commission, and you have to meet the conditions of the stockbroker where you want to list the shares. Conditions such as the price that you will list your share, it must not be below, for example, the New York Stock Exchange. You cannot list your shares at less than $1 per share. Otherwise, it will be delisted. So all these requirements, you must meet them. Right now, finally, post-IPO shares also are subject to continuous regulation to ensure compliance with reporting and disclosure requirements. I'm going to skip all of this. Please take a snapshot, study it later. But in order for time, because we've already spent 38 minutes, and I've not even gotten to the part of the presentation where I'll be talking about the particular company that I want to present their product to you tonight. So I'm just going to skip this slide. I'm also going to skip this part because this one was basically comparing pre-IPO shares, IPO shares, and post-IPO shares. But let me just run through it quickly. So Zoom pre-IPO shares were sold for 30 cents, and that was in the year 2015. And they approached private individuals such as high net worth investors to participate in their private sales. And Peter Obi was approached in 2015 to invest at 30 cents per share. So that was the price of Zoom pre-IPO shares. But when they went public in 2019, it went public for $62 per share. And then in 2020, October, traded for $559 per share. Now, if we assume that Peter Obi had invested just $500,000 in Zoom during the pre-IPO of 30 cents per share, that $500,000 at 2015 would have gotten him 8,417 shares at the rate of 30 cents per share, which if he had sold it at the price of 559 later in 2020, he would have sold it for $4,705,103, which at the exchange rate of 2020, 380 naira per dollar would have been 1,787,939. Sorry, 1,787,939,140 naira, which basically shows you how that investment would have made his 500,000 become 1.7 billion in just 5 years. So this is the kind of appreciation in price that is a potential for people who are able to buy the stocks of good companies in the private stage of their development. Now let's move on to a very important topic, which is the reason why we are having the webinar we are having this evening. How do startups raise capital for their development? Please, which of these options is familiar to you? Type in the chat. Of course, they're already listed here on the slide, but which one is familiar to you? Just write them in the chat. You can see the way startups raise capital for their development. In fact, some of you may even be familiar with them. Number one, we have bank loans. Now, of course, banks are financial institutions, and one of the things they do is they finance ideas. So if you are a businessman and you have an idea and you need capital, you go to the bank, you take a loan, you give maybe some collateral, and then you take that loan based on the interest, you go and do your business, you pay back the loan, you pay back the interest. So this is one of the ways you can access capital to develop your idea. You have a solid idea and you need financing, banks are there to give you loans in order, as far as you can, provide good securities, good collaterals for those loans, and then pay back those loans with the interest associated. So that's why people usually say when a rich man goes to the bank, he's not going there to put money, he's going there to take. And the people who have more ideas than they have money to finance their ideas, they are going to the bank to collect. While those ones who have more money than they have ideas, they are going to the bank to deposit their money. So the rich and the poor, they interface in the bank, but for different purposes. The rich are going there to collect the money that the poor people are going there to drop in order for them to go and finance ideas that they have. To make money and still go back to those people, let me not use the term poor people, those people who have more money than they have ideas, to still bring those products to them to buy and then make those rich people even richer. So you can see that it is almost as if the rich are just benefiting from this whole setup, because the poor are eventually the ones who still become their customers by the time their ideas have now reached the level of developed product or services that is now profitable, that is now commercially viable. All right, so another way startups raise funds for their development is through private sale of their share. Private sale. Please note, I said private sale of shares, which means these are pre-IPO shares. So private sale of shares to high net worth individuals. Or we have private sale of shares through crowdfunding to members of the public. So another thing that some private companies can do is they can do crowdfunding. There's also private sale of shares through private placements. This is also for high net worth individuals. So basically accredited investors such as mutual funds, venture capitalists, etc. can participate in the private sale of shares. But when the company chooses to go through the crowdfunding route, then more people, more members of the public can participate. Also, one of the ways company raise funds for their development is through public offering of their shares in the stock market through a process known as initial public offering. That's IPO, like what Dangote Refinery is about to do. Now, let us talk about you. What should you look for when deciding or choosing which startup company should you support? In other words, where should you be investing your money? What are the factors to consider? Number one, look at the problem the company is solving for the market. What is the problem they are solving? Number two, check the scale of the market that has that problem the company is solving. Is it a market that is maybe a very small percentage of the market? Is it a big market? Is it, for example, is it a product or a service that's targeted at children below the age of 5? Then you now begin to say, okay, in the population, how many children below age 5 are actually there in this market that can afford to even access this service? How buoyant are their parents? Is this problem something that the parents consider painful enough to be willing to invest in the solution, to be willing to pay for the solution? So these are things that you look out for. So the market, if it is now a market that has a bigger demand frequency, you can begin to say, okay, I want to position myself as an investor in this project, in this company, because I see there is demand for what this company, the solution this company is providing. So another thing you look at is the demand frequency, what I can refer to as the sales turnover. Please note, I'm using very, very layman terms in this presentation. And if there's any part you don't understand, feel free to ask questions. Because they say a closed mouth is a closed destiny. So if you have a question and you keep it because you don't want people to, know that you don't know, then how would you now get your solution? So please feel free to ask questions. Call me back if possible, or at the end of the presentation, I will take all the questions and I will answer. So now, demand frequency is the sales turnover. For example, if you look at a product like mobile phones, for instance, how often do we buy them? How often do we change them? Maybe somebody buys a phone. Will the person need to buy another one in, let's say, a year? If that phone is good and that person does not have a desire to always buy the latest model whenever they release a latest model, that person can use that device for the next 5 years, the next 6 years, 10 years. As far as the device is okay. In fact, mobile phone companies, in order to ensure that you buy their product, they'll give you a guarantee. Maybe like a 2-year or a 1-year guarantee that this product will serve you for this duration without issues, without fault. The same thing with laptops, devices like that. They are devices that have low frequency of demand, because ideally when you buy them, it should be a product you buy once and you don't need to buy over and over again. And if the product is faulty and you have to change it so frequently, I can assure you nobody will go and buy that brand or that particular product when they want to change the faulty device. So sales turnover is something to look out for in terms of whether am I investing in this company, how do I see the demand frequency of their product. Then when you check a product like transportation, for example, the demand frequency is higher because you must move, go out, you must come in every single day, you go to work, you go to the hospital, you go to the market, and you must go and return. So a product like transportation has a higher demand frequency than buying a mobile phone. So that at the end of the year, what you would have spent on transportation probably will be much higher than the amount you spent buying a phone, even though the price of the phone might be higher in terms of the amount you have to pay for one device than transportation, which is a service you use every day. So these are things that you might look out for in terms of the price of the product, the demand frequency, the market, etc. You also look at the competitive advantage of the company that helps it stand out. For example, you want to invest in a mobile phone company. Now begin to say between Apple, Samsung, Infinix, which company stock should I buy? Which company what is their competitive advantage that will make the product or the company's product stand out in the market. What's their unique selling point? Then you now say, okay, this one has stronger brand recognition, this one has a stronger technology, this one has patents, let me invest in this one, not in this one. So these are some of the things that you do. So when we say do your due diligence, when we say do your own research, these are the factors that you should research. It's not just to go and be browsing about the product. You do specific research. Basically, everyone who has gone through the university probably submitted a thesis for their BSc or MSc project defense. So the way you research that subject matter that you studied, when you want to make investment also, you ask the same kinds of questions. You go ahead and do surveys, you check findings that have already been reported, in order to make a decision that can minimize the level of risk that you eventually expose yourself to. Of course, like I said before, every investment carries risk, but your research can help you to minimize the risk, or at least to be fully aware and conscious of the risk of the assets that you are acquiring. Remember, investment is the acquisition of assets that appreciate in value over time. Now, other factors you can be looking at when you are thinking which company should you invest in is factors like the management team, the growth plan, and the financial, if you have access to that information, their revenue growth, their debt level, their profit margins, etc. Okay, beautiful. Now we've come to the end of the first part of the presentation. Now we are entering into the second part of the presentation. I'm going to take a pause here in order to interact with those who are currently on this call. Are there any questions at this point before we move on? Mr. Bola Yusuf Oyetayo, Miss Patricia, Miss Maria, Miss Aminat, Mr. Godwin, are there any questions before we move on to the second part, where we will now be telling you about the DigiU company and how to move from a tech tenant to an AI co-owner using these DigiU companies, leveraging this DigiU platform? Any questions at this point? Just type no in the chat if you don't have any question. Okay, all right, beautiful. So this foundation we just spent time laying is important, very important, because for many people, they don't really understand, and understanding is what builds a home. The Bible says, through wisdom, a home is built. Through understanding, her rooms are furnished. So without understanding, you might struggle. Okay, so let us proceed since we don't have any questions. Let me share my screen again. One moment. Okay, one moment. Just I'm trying to share my screen. Trying to find the option to share my screen. Well, okay, yes, found it. So at this moment, we're now going into the blueprint for decentralized personal artificial intelligence. The DigiU blueprint for decentralized personal artificial intelligence. We're talking about more than just usage of artificial intelligence tools, or the opportunity to become a co-owner of the $1 trillion global ecosystem DigiU is building, which covers artificial intelligence, hardware gadgets, financial tech. So this is the strategic bridge round of the DigiU ecosystem project. Now, why does this company exist and what problems do they solve? Currently, we have 90% of the demand for global AI and GPU markets controlled by only a handful of US-based corporations. What is going on with my slide? Sorry about the network. It seems like it's there's a delay between when I change my slide from my end and when it appears on my screen, but I'm connected to the call with my tablet. And when I move my slide, I see the feedback when the slide changes. Apparently, it's taking a little bit of time, but bear with the network. All right, like I said, it's just a handful of US-based corporations that control 90% of the GPU market, the global AI market. We have companies like NVIDIA, Microsoft, recently SpaceX, because they are also going into that space. Then Alphabet, these are the companies that control almost 90%, if not more, of the market for GPUs and for global artificial intelligence. Now, this has created this state where any corporation, individual, or business, even government that needs to access the most powerful technologies needs like corporate permission. And there is total dependency on this few handful of US-based corporations. Now, what this has created is this dependency model where you are more or less a tenant in another person's technology. You pay for the subscription, you pay for tools that you don't own. As you are using those tools, your data is being harvested and used as the new oil to build the corporation's wealth rather than to build your own wealth. And currently, centralized data harvesting is stripping users and businesses of control of their own digital identity. Furthermore, for you to develop centralized artificial intelligence, you need a massive capital base because the infrastructure is a very, it's not cheap. So because of this exorbitant cost, it's now like a barrier for new entry, and it has created this bottleneck for global AI adoption. So this is one of the problems. If you yourself you are not proactive, you just remain like an observer, what you are going to be faced with is two options. The option that you do not adopt personal AI. In that situation, your professional skills will lose value, you will lose relevance as a competitive business unit, and within 5 years, you risk becoming a relic of the past. You risk becoming forgotten. Second model is that you adopt the AI as it is, the current model, the centralized models, and you become a tenant of big tech companies. You are using their products, you are subject to their pricing rules, and it becomes your reality. Now, if you also remain passive, you will fall into the possibility of, let me give you an illustration. I watched a video where they said, if you want to know how a rich person thinks and how a poor person thinks, you ask a question, how much is a bag, for example. If you tell somebody this bag costs $1,000, I wish I could have a bag to illustrate. Now, a poor person will say $1,000 is too much, I will not buy, and they miss out. But a rich person will ask, what is inside that bag? If that bag has, for example, $100,000 inside it, you see, $1,000 to buy a bag that has $100,000 inside it is no loss at all. You are getting more value than you are spending. So the poor person would have lost out on a potential $999,000 profit just because they did not ask what is inside this bag. Now, let me tell you what is inside this AI economy. The UN Trade and Development 2025 report says that the global AI market will rise to, currently is at 189 billion, or actually when the report was done in 2023 it was 189 billion value, but they say it will rise to 4.8 trillion by 2033. So are you going to be in that market as a consumer, or are you going to be in that market as a co-owner? If you do not position yourself today, you might be missing out on the potential upside of this AI economy, and you might fail to own the underlying infrastructure of the next iteration of the web, miss out on a market that is projected to get to trillions of dollars in market capitalization. So would you remain a co-owner, or would you remain a tech tenant, or would you act in order to position yourself as a co-owner, is the big question that each and every one of us will need to answer before the end of this presentation. Now, the paradigm shift that this company, DigiU, is presenting is a model where users will have privacy of their data and where they will have ownership and profitability in the usage of computing power, as well as the usage of their artificial intelligence, their personal artificial intelligence. So DigiU is creating a system of decentralized personal artificial intelligence. And their model is that all this centralized company where there is focus on having a centralized infrastructure where all the data is collated in one place, everybody is using artificial intelligence provided by singular entities, and they are training models. Their information is, centrally collected. It's not the approach of DigiU. DigiU is looking at creating decentralized personal AI where you can have your own AI trained by your own information and input, and this AI will become knowledgeable in the things that you do in order to be able to assist you effectively, but your data stays within your control. And the device that houses your data will have processing and computing power, which you can also connect to a decentralized network. And you can then rent out the capacity that you are not using through their app. You can get paid for it by others who are using the computing power that you are not using. It does not end there. That as you are earning from the rent of your computing power, you can also become a co-owner of the company by buying their shares and earn directly from the profit that the company is making through the sales of these gadgets, these AI gadgets, the AI wearables, and the AI hub, which carries the data and the computing power. And as a co-owner in their ecosystem, participate in the development, participate in the profit sharing. So they are transitioning you from what it used to be centralized AI to decentralized AI, where you have ownership of your data and ownership of the entire company's infrastructure and ownership of the computing power that you can even rent out to make money. So that's their model. And I think there's a short illustration video here, which I'm just going to play to illustrate this model.
For every important part of life, we got a separate device. For health, for memory, for money. But what if the essentials could come together in one? On your wrist, a device that understands your body, tracking strain, noticing stress, helping you know when to push forward and when to recover. In the middle of your day, it captures what matters: conversations, decisions, next steps, turning speech into structure and giving you back clarity, focus, and control. And when it comes to money, it makes action effortless. Pay in one motion, stay connected to your financial tools, and keep digital assets closer, safer, and easier to manage. One band, one app, one system that brings together your health, your actions, and your assets in one clear view. And beyond the wrist, it becomes part of something bigger, your band. Through the day, it helps you act. And at home, it returns what your day has learned to your personal protected space. Private, connected, working in your interest. This is more than a wearable. It is the first step into a new personal ecosystem. One band, one app, one ecosystem.
So this is not just software. They are also building hardware. They are also building the physical ecosystem, the AI gadgets to go along with the software. So their suite includes the AI hub. Now, what's the AI hub? This will be your personal in-home supercomputer. Then you can also have wearables, and they can include watches, glasses, even AI cards. These devices are all integrated into a decentralized network for local storage, which will ensure that you yourself have total privacy, and it will allow you to mine computing power, to validate computing power, and to share computing power directly through their DigiU application. Now, this is going to ensure that we move from the centralized model of usage of computing power in this AI development. Oh Christ, my video is my video is not on. So sorry about that. I took a moment to play that video we just watched, and I turned off my own video so that there are no interruptions, but I forgot to turn it back on, and nobody gave me that feedback. I just saw it now. So let me just backtrack a little bit. It's important. I always like to do a presentation where my audience can see the person that is interacting with them. So like I said, this is not just a software, it is also the hardware that goes along with it. And this hardware includes the DigiU Super app, that's their AI hub, the DigiU glasses, the DigiU wearables, watches, cards, etc., all integrated into a decentralized network where you have local storage and you have privacy. So you can mine, validate, and share computing power through their app. Now, this is a transformation that takes you as a user of AI tools from just the model where you use them, pay subscription, to the model where you own your computing, your AI hub that has your computing data, has your computing power, and you can also rent it out and earn from it. So the model where you can own stakes in the company that provides you the AI tools that you use, and you can participate in the profit as the company is growing, to a model where you as the co-owner is the person who has full control of your data. Your data is not being harvested to make an AI company software smarter, that at the end of the day they release better models and they collect or charge people higher subscription fee, and you yourself don't participate in that profit. So this is the model DigiU is introducing to the AI market. Now let me ask you a question. Do you think this model will scale? Do you think people will adopt it? Do you think the market is ready for this kind of solution? Tell me your answer, yes or no. Because you remember when we were discussing earlier, I asked the question, I said one of the things you check before you now say, okay, I want to invest in this company is, what is their market? What's the demand frequency? First of all, in terms of the usage of AI, first of all, is there a demand for AI in the market presently? Yes or no? The answer is yes. Do you think people are comfortable using AI and their data? You fully know. As you are registering for the AI tool, they will tell you your information and your chart can be used to train this model. You might see the option to agree or to disagree. You might see the option to turn it on or to turn it off. But in some models, you won't even have the option of choice. It's just there. They'll just notify you. You have no choice but to agree, except you don't want to register. So in some models, do you think people, if they had the option to say, the data that is training this AI is within my control, I can see that all that my device is learning about me is going into this app, and the app is under my control. It's like how you have cryptocurrency wallets. We have decentralized wallets like Trust Wallet, where you have access to your wallet, nobody else has access to it. And then we have decentralized ones that is on exchanges like Binance, Bybit, FTX. And you remember what happened? FTX exchange, it crashed and people lost their money. Imagine that you had that's one of the risks with centralized data storage. Your information is with someone else. You don't even know what they are doing with it. But whatever they do with it will affect you. So those people who had their cryptocurrency in FTX exchange, when the exchange crashed, they all lost their significant amounts of their money. But those people who have it in their own control, in their own decentralized wallet, nothing can happen to it. The only thing is, if you lose your access, that your crypto key, then you may not be able to access it. And do you know how easy it is to transfer wealth? Or even like, for example, this, because when you talk about will, preparing your will, many people don't really take time to prepare these things. But if you have a decentralized crypto wallet and maybe your next of kin, that could be your wife, that could be a member of your family, they know the access to that wallet, they have the key. Any day that you are no more, that wealth can easily transfer to another member of your family, to your next of kin, whether you prepare a will or not. Well, it's not like I'm saying you should not prepare your will. These are some of the things that many people don't emphasize, especially in this part of the world. But these are important financial preparation that each and every individual needs to make. Anyway, I'm digressing a bit. But what I'm trying to say is that decentralization is the future. Most people will go for systems that they can control, not the systems that are being controlled elsewhere. And so this is where we are going. And this is how the market is evolving. If you even look at personal computer, it was not always personal computer. We had a time when computer access was centralized. You want to use a computer, you go to a cyber cafe. Even before the cyber cafe, we had computers that were housed in offices. They were so big that you need a whole room, like this room I'm in right now, to just keep the computing power, the computer's processor. And to use them, you have to go to the place where they had those things set up. But today now everybody has computer in their house. So DigiU is visualizing the future of AI, that it will follow a similar developmental trajectory where at a time in the future people will have their own computing power, and DigiU is preparing for that future by trying to develop the architecture and infrastructure for decentralized personal AI. So the market needs this solution, and these are some of the factors that will tell you whether the company's product will scale when it finally hits the market. All right, so now let us talk about how the company creates value. The company does this through their AI and blockchain lab. In these labs, they develop products. These products are funded by the community, are tested by the community, and the community is also able to participate in the profit that comes from this product through dividends, through buybacks, through bonuses. So that's how the company returns value to the community and how the community gives value to the DigiU ecosystem. So it is a win-win model. One of the products that this company has actually developed from their AI lab, their blockchain lab, is a product called the RWA Bank. And that RWA Bank has a product called Deposits. That product helps people to earn returns on their capital annually and even monthly. And so this is one of the ways that as a member of DigiU in the ecosystem, you can just leverage that product and get returns on your cryptocurrency assets on a month-to-month basis or annual basis, depending on the term that you choose. Now, the next way that DigiU gives value to the community is through their venture capital fund. DigiU has a venture capital fund that invests in other projects in AI, blockchain, and fintech. And as they finance these projects, some of these projects, they go on to become unicorn. They go on to become successful projects. And this project also returns profits to the company. And through that, the company is able to pay dividends to the investors. The company has paid dividends even though it's still in the startup. And this is just one of the ways to encourage their investors and to signal the potential growth that they anticipate will happen in their industry. Now, these dividends are not guaranteed because it's not every year the company has paid dividends. I think they have paid they paid 7 times in the last 6 years. although the accounting period varies. So there was a period that payments were not made. So it's not a guarantee. However, the company is trying its best possible to ensure that these payments are regular. So I would say that being a project supporter of the DigiU ecosystem has a very positive outlook because the company is developing with the partners in mind. Now, if we were to compare the models of centralized AI with the DigiU AI, DigiU personal decentralized AI, there are so many benefits of the DigiU model. And one of the benefits is that it will help you move away from, subscription model, renting AI, and then giving your data to a model where you are creating more like a digital twin, a digital version of yourself. As your information is training your personal AI is becoming more and more like you, able to perform the activities that you perform, complete the task that you normally would do, earn income for you, and save information that relates to you, such that you at the end of the day would have created for yourself a digital double. And in fact, there's this concept of DigiU. In fact, DigiU stands for digital you. So DigiU has this concept of the term will come to me. Just give me a moment. I'm trying to recall the term. Well, I think I'll find it in the slide somewhere. But it's basically the creation of a version of you that outlives you. Digital immortality, that's the concept. Digital immortality. So as your AI becomes smarter and becomes more and more like you, the day you die, that information is still available to the people who, for example, your next of kin, your family members, and they can interact with the information that you have, deposited in that device, and it will almost seem as if a version of you is still alive. So that's the concept of digital immortality, which DigiU sees as a byproduct of their technology. Now, this is how their company has been scaling over the last 5 years. Their community of partners has grown up to over 150,000 registered members across 184 countries, and they have over 24,000 of those who have become co-owners in their company. This ownership model that we are talking about, over 24,000 people have leveraged it. And in terms of commercial bonuses, they have been paying out commercial bonuses up to $2 million. And they have completed 6 dividend rounds and paid out over $340,000 in dividends. And they also have fintech products in the form of Webwise Pay. Now, I'm not going to dwell on their portfolio so much. Neither am I'm going to skip this video talking about their fintech product in order for us to save time. Now, the company's institutional and legal framework, they have the following document. They have state IT accreditation of their holding company, which is registered in the EU jurisdiction. They've also secured what is called an ISIN. ISIN is like a number. It's a securities registration, and they secured that through the Cyprus Stock Exchange. Currently, they are undergoing institutional auditing because they want to transition to Series A. But for now, they are still in the bridge round, which is the window of participation that we have. This bridge round is estimated to close in the next 12 to 24 months. And the bridge round is a process of offering 10% of their company for crowdfunding, and they want to raise $50 million for 10% of their company. Now, they are aiming to scale towards $1 billion capitalization target. And this window of participation is their bridge round is just meant to span 12 stages across 24 months. Now, it's important to mention that once this current bridge round of financing finishes, there will be a higher barrier to entry, and the chances to buy stakes in this company at the current valuation will be gone. So before the company now exits into Series A or IPO, it's possible to participate through the bridge round and become a co-owner in the DigiU ecosystem. So what have we talked about so far? We've talked about the fact that the company's product is in demand, their idea is solid. We've talked about their ownership model, where the user controls their data, the user controls their data is private, the user controls their computing power, and they can also rent it out, and the user can also become a stakeholder in the company that is providing all these tools, earning dividends. We've talked about the fact they've already paid dividends. We've talked about the fact they have products, some of which can enable you to earn monthly and annually, like the RWA Bank product. And beyond all of this, there's also the creation of digital identity. I talked about digital immortality, which can ensure a preservation of your knowledge, in fact, preservation of your personality in order to assist your future generation. So all of these are what the company offers to partners. And you can actually secure stake in the company by buying their shares. And the price and entry is through your DigiU back office. If you go to your back office right now, you see the packages available for participation, and the shares are priced at 0.0025 to 0.0036, depending on the package that you choose. There are packages starting at $500 but can be paid in installments of $50 per month. And there is 14-day full refund guarantee, so that if you should choose to invest and then withdraw your participation, it is entirely possible, as far as you do that within the 14-day window. Now, if you want to participate, you can participate as through the crowdfunding. That's you can invest from $500 in installments of $50 per month, so the window of participation is very broad. Or you can invest as a club or a syndicate or club format. This one is for entrepreneurs and business angels. And then there's the venture capital format for those people who want to invest significant higher amounts. So depending on what you have in terms of your capacity, you can pick any suitable format to participate. Now, what do you need to do right now? Go back and create an account on the DigiU platform if you have not already done so. Then make a purchase of a package after you must have done your own thorough due diligence on this project. This is my recommended action step. At this stage, I will now stop my recording and ask if there are any questions.